If you guys have been in the dividend space for any length of time, you're definitely familiar with QYLD. About a year and a half ago, this fund was one of the most popular covered call dividend ETFs on the entire market. I've made videos in the past of how this fund works, my thoughts on it, but today we're going to be revisiting it in 2023 and seeing whether or not this fund makes any sense to be investing in. And stick around to the end because I'm going to be giving an alternative. It's very similar to QYLD, but I think personally is a much better investment. So I hope you guys enjoy. If you do, leave the video a like, subscribe, all that kind of stuff. It's greatly appreciated. And let's get into this. Okay, so the first thing I want to point out is that still in 2023, QYLD is the most successful and largest fund that Global X offers. It has net assets of $6.8 billion. And the strategy that QYLD, XYLD, RYLD, and DJIA follow is very basic. So they buy the reference components, the index, and then they write monthly at the money covered calls on 100% of the portfolio. This is done to maximize the income generation of these covered calls. The trade-off of doing that, of course, is in order to maximize income, you forfeit 100% of the upside growth potential. So to put this in writing, I can give you guys a basic example of how these call options work. So the time frame is 1 month, and let's say at the first of the month, this asset is trading at $100. And having an at the money covered call means that you're selling this call option at the current trading price of $100. So let's say, for example, the price of this asset fluctuates over the time frame of 1 month, but ultimately it's a green month and the price ends up at $110. That means the person that you sold this call option to can now redeem this asset at the previous price of $100 versus the 110 that's currently trading at. That's how you forfeit all of the upside growth potential of this underlying asset. And that's why lots of call options use an out of the money strategy. So that would indicate that the call option is, say, up here at $120. That, of course, will allow you to capture some of the upside potential, although it still does have a cap at that price. However, the more out of the money the call option is, the less it is worth, and thus the less income you generate when you sell it. So you have to decide between capturing upside and generating more income. So that's how the call options work with QYLD, and there's no put options. So what that means, quickly coming back to this diagram, the price is going to freely fall along with the underlying asset. Okay, so QYLD can go down with the market, but it doesn't go up with the market, speaking strictly about the fundamentals. So that means all of the return, 100% of it, is generated via selling the call options, aka the dividends you receive, which at the moment is a whopping 12.68%. And coming to the dividend history, this has been a fairly consistent amount over time with small fluctuations. Now, comparing QYLD to the index, the QQQ, this is the price action over the past 1 year. As you would expect, when the market was going down, QYLD followed suit at essentially a 1-to-1 ratio. But when the market recovered and went up, QYLD was lagging behind. But ultimately, in this bear market, QYLD performed very similar to its underlying index. However, when you zoom out on a longer time frame, QYLD does not have good price action at all. But if you understand how the fund works, as we just went over, this should not be a surprise to you, and you should be looking at the total return of the asset, which includes selling the covered call. And in this view, over the past 5 years, QYLD has an annual total return of 4.83%. And this right here is the main problem with this ETF. The total returns are just not competitive with other, even similar income assets. So for example, Divo is kind of similar. They have covered calls, it is actively managed, and over the same time period, they have an annual return of almost 11%. The dividend isn't as much, it's only about 5%, but that's still pretty meaningful, and it combines that with some capital appreciation to give you pretty solid overall total return. And I've talked about this before, but when it comes to investing, I view it as a spectrum. On one side, you have growth and heavy speculation, and on the other side is income investing. So for example, on this side, you might have something like the ARK Innovation ETF. This has a super high level of volatility and essentially no income or dividend characteristics. And then on the far extreme side of income investing, we have something like QYLD. Zero price appreciation and focusing 100% on high dividend income. And you can make the argument that both extremes of the spectrum are not ideal. Now, that's not to say that you have to be in the middle of the spectrum and invest in something like the S&P 500 exclusively. As investors, we all have different goals and objectives that we want to accomplish. So if you want something that's a little bit more conservative in the S&P 500 and a little bit more income, you might want to go with VTV, a broad market value ETF. And if you want to go even further down the income spectrum, you can go with a fund like Divo. The main consideration is the total return. You still want competitive, risk-adjusted total returns at the end of the day. And when you go too far down the spectrum in either direction, you begin to lose that. So yeah, to me, QYLD is a little bit too extreme of an ETF. But I still think that this strategy of systematic monthly covered calls can be successful. And for that, I think QYLG, and more specifically XYLG, is actually a much better implementation of this. And the only difference here is that they sell at the money covered calls on half of the portfolio, so the other half can freely appreciate along with the rest of the market. So QYLG introduces half the growth of the underlying index while giving you a pretty solid dividend yield of 6%, exactly half that of QYLD. But I will give you a warning when it comes to this strategy, and that is to watch out for excessive volatility. So just like with QYLD, this has no put options. So you're essentially going to capture 100% of the downside of the market and only recover 50% of the upside, plus the high level of dividend income. But due to the way the market works, if there's a 50% correction, you actually need 100% gains in order to get back to where you started. When there's a low amount of volatility, the difference isn't that massive. So if the market goes down 5%, you only need a gain of 5.3% to get back to the break-even point. But when you get down here to bigger numbers, say a 60% correction, then you need 150% gain to get back to that break-even point. And this problem is only magnified by this strategy. So if it was my money, not financial advice, I would avoid the more volatile indexes like the QQQ, and something like XYLG based off of the S&P 500, which is less volatile than the QQQ, might be a better alternative. So ideally that would keep the losses relatively low, easy to recover from, and when you combine it with the above average dividend yield, the total returns will be okay. And to prove that, if we type in XYLG, these are the total returns since the inception. The history isn't that long, but still has an annual return of 10%. Comparing it to the S&P 500 over the same time, this is the comparable returns, 12%. So it still is lagging behind the market, but the difference isn't that massive. And remember, in exchange for that slight underperformance, you're getting a much higher dividend yield, putting you more on this side of the spectrum if that's something that you want. So I hope you guys enjoyed the video, got something out of it. Of course, let me know your thoughts in the comments below. If you're still watching and enjoyed, leave a like, subscribe, it's greatly appreciated, and I'll see you guys in the next one.